presumably it's not
Yeah,
all organic.
Yeah, exactly. A lot of organic growth and a lot of add-on acquisitions, many small clinics, some larger add-on acquisitions, et cetera. We've also driven digitalization and sustainability, building a great company, actually. And the point is that what we paid for that first platform of 300 million doesn't really move the needle in terms of what the company's worth today. And that's the kind of mindset we're trying to have is price. If price is the determining factor for your return, then it's probably not the right deal to do, particularly in high multiple times. So we're trying to find platforms, investment opportunities where we can really add value to them and still make a good return, even if the price was high in the beginning. So that's how we think about it. And another tool, of course, that you have is that if a deal was done in 2021 at a very high multiple, if you're going to create a return on that, you might also need to own the company a little bit longer and do more with it. So spend one more year, maybe make the same multiple of investment costs, slightly lower IRR, but still make the same amount of total capital gain, or hopefully even more. And that might take a little bit more time and more skill and more effort, but that's what we build into all of our capabilities. How do we add that value through excellent governance, bringing in great people, driving, making companies more sustainable, which we believe really actually creates more value in the long term, because you become say more popular with all stakeholders, including clients and employees, et cetera, creating more value that way, driving digitalization, whatever the themes might be. And that becomes pretty important. And that's why we build a lot of skills into that, both within EQT and within our network. Okay,
I find that fascinating that you were buying companies for a few years and assuming that in your model of what you were going to do it, how you were thinking about your returns, that you were going to sell it for 4 times of EBITDA cheaper than you bought it. So say if you bought it for 14 times earnings, cash flow, earnings before interest, taxes, depreciation, and amortization would be the full one, then you would be expecting to sell it for 10 times. What are you doing at the moment? Are you looking at the market and saying, we'll keep those multiples flat? Or do you think that there could be, because obviously they've come down since then?
Yeah, it's a little bit more dynamic because what I gave you was an average. So sure. Again, we're breaking it down to those 5 or 6 investments you're doing per fund. And right now, we haven't done that many investments in this kind of new market that we're in. Actually, I would actually say that even since the beginning of EQT, we've always expected to get a little bit lower price, because you don't want to rely on the market rescuing you for returns. If you get that upside, that's great. But you'd rather, you rather want a more aggressive business plan, which pushes you to create more value in fundamental value in the company, and the market will price it the way the market prices it.
Got it. And just to draw out another theme of what you just said, just looking at the data on exits, they have sort of trailed off in Q1, Q2. You said, or I think you kind of implied, that companies, sponsors, EQT, KKR, Blackstone, all your rivals, you might have to hold companies for longer. Is that going to be across the board? And what's driving that? And does that equal a lower percentage return for your investors, the limited partners? Or is it sort of you can offset that by doing more things to the business? There are more kind of add-ons at lower valuations at the moment.
Yeah, our conviction is the latter. We're not reducing our return expectations. We haven't done that, during this recent upcycle either. So it means that we need to work things through more deeply, and I think another way to flip it around is to say, okay, when times are really good, you want to maximize your exits, because you can exit actually both good companies and the less good companies, and then you also have there's also an element, there's portfolio construction, what kind of companies and themes you're investing in a single fund, but there's also how many funds do you have open. In private equity, our most recent fund the oldest fund of the whole portfolio is from 2015. And it's the same in infrastructure, except for one company left in our 2012 fund. And that means that we've sold off a lot of the older companies and have a smaller, younger portfolio, which means we have more time to work the portfolio and more time to do new deals as well. So that's that kind of thinking of it, private equity as a business. that's actually a pretty important part of how, how we're working it. And if you look at a lot of our competitors, they still have companies from 2005 and 2007 and 2010 in their old portfolios, and that takes, to us, that's the distraction. And we want to work with where we can really make a difference, and that's more current.
Got it. And just on this holding time, I'm going to turn to ESG in a second, but just holding companies for longer.
Yes.
We have seen this theme of companies taking an asset, of private equity firms taking an asset they already own, that's been in the fund for a long time, and then putting it in a new fund and saying to the investors in the funds, hey, you can keep holding this asset, and sometimes you'll bring in third parties. I think you've done a few of these things. There's been quite a few big ones in recent years. What do you think of this practice? I mean, there's obviously a lot of kind of governance issues that spring up when you're transferring assets internally, as the valuation being validated externally and stuff. First of all, do you expect to see more of these deals? A continuation fund, I think, is the phrase for it. And is that something that your investors should welcome? Should they be happy about it, or should they be unhappy about it?
Yeah, you could take a step back and say, hey, why is it happening? Well, the why it's happening comes back to actually portfolio construction, if I want to use that technical term, and it has to do with running with the winners. So if at least that's what most of the industry is doing within what we were doing as well, and that's you have a great company like IVC, great company, lots of global expansion possibilities, super management teams, fantastic board. It's very thematic. It's sustainable. The underlying trends are about personification of pets, and which is a mega trend all over the world. That is a company we want to be invested in for a long time. And in the old-fashioned private equity, you had to sell that after 3 or 4 years. But now with these new tools, you can actually say, hey, there's so much expansion opportunity, and we know so much about the industry, about the company, people, culture, and everything, that it's a lot lower risk with the same reward to continue and run with that business. And you have to find ways to do that. You either do it, by investing in a new fund, an existing, the next fund or the fund after that in the same series, or you create a separate vehicle to do it. And each time you need to bring in some third party to make sure that the price, of course, is set at arm's length terms, because that's where you mentioned the conflict. That's where the conflict gets a little bit complicated. But the mindset is, let's run with this winner. And a lot of the clients, really think that's very exciting, because also for them, it's a lower risk, higher reward type of situation. So, so I'm quite positive to it, but it's of course it needs to be. You need to be, since you are doubling down on something, of course you need to have real conviction that it's going to deliver.
Great. So let's move on to environmental, social, and governance concerns, which is this huge kind of movement that in the past 3 or 4 years has really swept through every area of business, and particularly in private equity, we're hearing more and more about it. I think EQT talks more than the average private equity firm about ESG by quite a long shot, actually. Who's driving this? Is this your clients, your investors saying, hey, you've got to talk more about ESG? Or is this you saying we can make more money by investing in ESG things?
I like how you asked the question. It's actually both. If you think about where did EQT come from? Well, we came from, and our largest owner is still the Wallenberg family, and they've been owning companies since 1856. They're a very responsible owner, great long-term owner of businesses. And we had a mindset when EQT was created. We were more than capital, was our moniker at the time. Now our purpose is to future-proof companies and make a positive impact. And the reason that we believe that we don't really talk so much about, we don't call it ESG internally necessarily. We call it transformation or working within sustainability. And that is that we believe if you take two companies that are exactly the same, and one can become more sustainable than the other. So let's say two IVCs, and one is
this is the veterinary.
This is the veterinary care company, and one of them has much better diversity in the management and in the group of employees in the company. It's more digitized, more modern, more open. It has better control of its its supply chains, better working conditions, you name it.
Pays attention to its carbon footprint, etc.
Yeah, exactly. Pays attention to carbon footprint, where its energy is going to all the clinics, how it's buying its, its tools for operations, you name it. That one is doing that. And the other company is exactly the same and not doing it. Which one is going to attract the best new talent? Which one is going to, when you're driving an expansion, which clinic is going to want to join that group? Well, we believe it's, the momentum is going to be towards the company, which is more sustainable. Which one is going to have a better relationship with regulators? This one, because it cares more about it. Ultimately, that means that the company will develop better, and it also develop, drive better financial returns. So it's actually, my colleague Thomas always says, doing good is good business. And that's how we think about it. It's, it's actually creating, it's fundamentally the same as a private equity, or at least our kind of private equity has always done, making companies better. And it's using these themes, which are very positive and important to us, but using them also to create value.
Just a few follow-ups on that. So you kind of mentioned, if you put two companies side by side, one of them is more climate conscious, more sort of governance focused, socially forward thinking. This one's going to do better. Are you seeing that in terms of prices? We've just had a question in from the audience, which I think is a really good one. Like, how is ESG feeding into the prices of assets, both when you're selling them and when you're buying them? Are they getting quite expensive now? And are you noticing a sort of, multiple valuation effect when you're selling these businesses?
Yes, and it's still it's always hard to measure because you don't have those two exact same companies. But right. You can compare the competitors in the industry and prices of public companies, et cetera. So we're convinced, and we see the level of interest being higher in those companies that are more future-proofed. I think you mentioned that earlier. And we have a good example, actually. We actually own the world's largest company providing school bus services to students in North America.
Right.
The yellow
the business you bought last year, right?
Yeah. First group. Yeah. So yellow buses. So why in the world?
Just to make clear for our audience, the iconic yellow school buses, EQT is the owner, basically.
Yeah. It was the owner of the biggest company in the world with the yellow buses. They have 60,000 yellow buses now, I think it is. And people ask themselves, okay, why do we buy these yellow buses, the school buses? Well, we actually bought them because we saw an incredibly interesting opportunity to transform that business and drive, the decarbonization of that whole industry. So to actually create an electrical bus system for the schools across the United States, in every municipality, in every little town. And you can think about the positive elements around that. There's much less local pollution in terms of both air and noise. You get upskilling of the workforce. You build network effects because you have to have charging stations, and it just becomes a much more, there's much more positive momentum around the business. You actually create growth in the business, and for us as an investor, yes, it takes a lot of capital and time, but it creates a much more interesting company. So the number of buyers for the electrical and digitized bus network that we're going to have at the end of the day is going to be multiples larger than the old-fashioned diesel buses that we bought. So it's not just that it's not just one company more sustainable than the other. It's also about transforming companies and making them much more future oriented, and that's quite exciting, actually.
And on the client side, on your investors side, just in case anyone watching doesn't know how this works, every few years, Christian's investor relations team will go around and raise an unholy amount of money from big pension funds and sovereign wealth funds and insurance companies and the like, and then you'll go and invest that by buying companies. On the fundraising side, does ESG move the needle for you? Do you think you're able to sort of outperform the sector in terms of attracting ESG focused money, or is your client's primary concern financials, IRR returns, multiple of money, ESG if you can get it, but that's not moving the needle? What is it?
It's both, and it's kind of split a little bit in where you are in the world. So in Europe, if you're not driving sustainability, in the investment process, and also on the measurement side, which is a whole different question, but actually proving that you're doing all these things in a good way, then a lot of the European pension funds and pensioners just won't invest with you. So that's happening very fast, and it's been out there for a while. In the US, it's more split. That theme is growing very fast. but there's still a number of discussions as to, does ESG create value or not? And by itself, the three letters obviously don't, but the way we think about it is about making companies better. We're fundamentally convinced, as I said. And then in Asia, it's also still, a relatively young trend, but having a lot of conversations around it. So yes, there's more and more pressure coming in general, and you can understand it, because who are the investors in private equity? Well, it's actually the population, it's teachers, it's firemen, it's blue collar, white collar workers and their pensions, and they care about what's happening in society. So that's why these pension funds really care about it a lot. Many of them.
Got it. I just want to pick up the pace a bit here.
Yep, go for
a few more areas to get through. Just how do you get to the trade-off? There's a marginal euro being invested by EQT in a business that you own, right? There's many choices for that. You can make the company more ESG compliant, more sort of environmentally friendly, or you could just pursue profits. Like it seems to me there is often going to be a trade-off. And one example of this is, I think you have some funds where some of your partners, your deal makers' reward is linked to performance indicators that are around ESG. Yeah. So how are they incentivized? And is it just, returns first and then ESG as a bonus? Or what's the kind of trade-off there, and how do you assess that?
Yeah, this is the first time we build it into the long-term compensation model. Some of our bonuses, et cetera, are connected to this, but the long-term compensation models or investment models really around carry are connected to, in that fund called the Future Fund, 20% of that future potential is actually connected to 20% of the carry is connected
20%
to
20% of the 20%.
20% of the 20%.
Yeah.
Exactly, 20% of the 20% is connected directly to meeting these goals. So if you don't meet them, you get less. So it's not a bonus on top. It's actually it's the opposite. You have to meet those goals to get the full the full value of the carry. And and in Anticimex, which was the first investment that we made, this is a pest control company also that we're transitioning. Instead of driving trucks around and spewing biocides, we're digitizing the whole business. So we're installing digital traps, and in that process, we're upskilling the workforce, creating a better company. Ultimately, we'll have a pest control as a service company, which will be much more valuable, we think. And on the way there, we have ESG goals because we think it's so directly connected with that transformation. So if you don't actually transform, if you don't upskill the workforce, you don't digitize the business, then you shouldn't actually deserve the whole carry because you haven't created as much value as you can. So it's really connected again with value creation, but doing it in an even sharper way. So that's the first time we do it, and we'll see. We think it's a smart way to again doing good is good business. Yeah.
Got it. And so on to a slightly more uncomfortable issue for you, I can imagine. There was some news not too long ago about the Swedish regulator worrying that you had messed up the disclosure of some insider share sales. It's quite a sort of very specific, slightly nerdy kind of issue, but it's the kind of thing that investors really care about. Could you just give us an update on that regulatory probe that you're facing back home in Sweden? And more broadly, what was going on there? Why was it necessary for you to allow your partners to sell down earlier than you'd originally planned?
Yeah, actually, there's no news on that issue. So the regulator has been reviewing it since last fall. We believe that we followed all the regulations and did it in the right way. This is actually, if you take a step back, it's actually shareholders selling down shares in a public company, which happens all the time. And you do that through a book building process. You probably know this quite well. It's a book building process, and then when the sellers and buyers are there, then you execute. And then the question that the regulators were asking is the time between certain decisions and the execution of that was one question, and then it was actually a technical question on on certain information that was collected, where a very, very, very minute piece of it was not complete. So I agree with you. Two kind of nerdy questions, and we believe we did it the right way. This was the largest secondary offering in Scandinavia for many, many years, and needed to be really well planned and well executed. And it was well executed. We placed the shares with high quality shareholders, and Let's say that our clients and our shareholders and our partners and everyone we're happy with the result. But the technical questions are going to be analyzed and
just on the technical question, what was the piece of information that you were referencing?
It's when you have a public company working on let's say a large M&A deal or having new results or whatever, you have an insider list, who has inside information. And that insider list was complete in actually every way, except that a couple of the people on that list, we didn't have their telephone number or email. We had other information, but it was really very specific and very nerdy. Obviously next time around, we're going to make sure that every field is covered, but there's no fundamental problem. There's nothing, there's nothing there in terms of missing information or forgetting to include people or anything fundamental. So it's really quite technical.
But just stepping back.
We're hopefully we'll be able to put it behind us soon.
Got it. But just stepping back from the specifics of the regulatory probe, or just putting that to one side for a second. Yeah. There was a broader issue which I think investors were worried about there, which was that you IPO'd the company, and there were a bunch of insiders, as you said, sort of senior partners at EQT who were locked up as part of that process, which is quite normal in an IPO when you're not allowed to sell down a certain amount of time. And at least my recollection is that you released some of them from a lockup, simultaneously put longer handcuffs on them for separate tranches of shares. But it did look like your share price was very high at the time, and there were some insiders wanting to get some liquidity at a high share price. Like, what do you say to that accusation?
I have to take a step back and look at the situation. We actually we had relatively low liquidity in the share, and we had a demand from shareholders to increase that liquidity. We had a lockup structure that was going to last another 3 years from that time, and in each of those 3 years, the amount of shares that were going to be released was just too big. So the lockup when we set it up was the longest lockup in Swedish history, but still, in the company's view, wasn't long enough. So we restructured it so that we could sell a few shares at a lower percentage of the total last year, and then we doubled the length of the lockup. So it was already the longest lockup in Swedish history. Now it's double the longest lockup in Swedish history. And the fundamental reason for doing it also was to create more liquidity in the share, which is good for all shareholders. Liquidity is up 2.5 times actually in the share since then. So that was the fundamental reason that the board executed on this. And this is obviously not the partners doing it. This is the board of the company actually approving it. So we thought it was actually, like I said, between all the different stakeholders involved, it landed really well. The timing of those things, the timing was about a year before the normal lockup would happen, and that's also quite natural, because that's within that time frame where you start to see, hey, this lockup is being released soon. Is there capacity? Is that going to be successful? And if not, well, maybe we can do something about it for the benefit of all the stakeholders around. So like I said, we're confident we did it right with the a 360-degree perspective, but it may be that there was a technical interpretation that's going to be different by the regulator, but fundamentally, no.
Got it. I mean, we could go back and forth all day on this.
Yeah.
But I mean, just so the audience is aware, there was the insiders who sold out at that point now look pretty smart, because the share price has fallen quite a lot. Anyway, let's leave that there. I think.
Well, then I have to rebut that one a little bit, Liam, because the stock went up. It went up about 25% actually after that first.
Okay.
So it depends on which time frame you're looking at. Yeah.
Fair enough. Fair point. So I just want to we're almost running out of time. There were some comments the other day which our audience seemed to be quite interested in, which I think it was the Amundi chief investment officer said some quite provocative things about private equity. And we've had some questions through about this on the screen. He basically likened some parts of your industry to a Ponzi scheme. And I think he was referencing this idea of private equity companies selling their portfolio companies to each other. When I presume you saw those comments, like what did you think of them? And as a one of the biggest, I guess, spokespeople for the industry. Like, what do you say to those sort of comments?
Well, first of all, I don't think he understands our business very well, because what is private equity? Ultimately, it's about, as we've talked about in this conversation, it's about acquiring a business, and not that many of them actually at a time, and really building that business with real people, real operations, over time, of course, also hopefully even better cash flows, et cetera. So we're actually creating fundamental value by making companies better. And certain times, a financial buyer might buy a company from another financial buyer. Actually, IVC, the original platform that I mentioned earlier, we bought that from another smaller private equity firm.
Right.
Because we, with our capabilities and our size, they've done a great job with it, but it was small. I think we've done a great job with it. Now it's much, much larger. So this is not a static, financially oriented trading strategy, which he could imply. This is much more fundamental, much more basic. We're owning and developing companies, and therefore I don't think it doesn't really hit the nerve in any way for me. You could maybe say that, like we talked about, parts of the growth market last year in the public markets and maybe the private markets was overpriced, but that's a totally different question. Right?
Okay. Last question, and this is just going back to your sort of strategic thinking hat. So you've been very active as a CEO. I don't mean in terms of M&A within the portfolio, within your funds. I mean at the sort of group level. You IPO'd the business. I think you sold your credit platform. You bought real estate. You've been building up infrastructure. And now you're doing the BPEA deal.
Yeah.
What are you solving for in the really long term? And the reason I ask this question is that, I cover this industry and I look at the really big Americans. They seem to have made quite a decisive strategic choice that, hey, we're not just private equity. We're not even just sort of, active managers of assets like companies and, infrastructure. We're asset gatherers is the phrase. And it's basically, let's just get as many assets on the platform as possible. If that's where you're going, I guess you'd need to maybe get a credit platform back. I guess you'd need to sort of build up other bits of portfolio. How do you think about that? Like, is that the natural destination for the whole industry?
I don't think so. I mean, our direction is different. We've said that what are we good at? Well, we're good at owning and developing companies and actively, assets also in real estate. So anywhere where we can be hands-on, where we can apply a value creation model, where we can apply great people's talents, where we can apply, digital competence, sustainability competence. Actually, we have a huge AI at EQT called Mother Brain. Actually, it's 30 data scientists that we're using to become a smarter investor with both data, but also finding companies, finding out on acquisitions, testing themes, et cetera. Really interesting stuff. And all this we're doing because we want to become a smarter investor. We want to deliver the best possible returns to our clients. And we think that's going to be the ultimate reason to invest in private equity or private markets, because we're outperforming the public market. If we're not outperforming, then much easier to be in a liquid strategy, right? Mm-hmm. So because they're committing, the clients are committing capital to us for 10 years at a time, and that's quite a long way and a long time to give your capital to someone. So for us, it's really about this fundamental, value creation. And if you look at our expansion, it's kind of two axes. One is slowly but surely becoming global, which we now really are with BPEA. And the second axis is which themes are we investing behind? And we have two segments. We have private capital and real assets. And in private capital, we have venture capital and tech, and venture capital and life sciences, two very important themes. And they flow into growth, they flow into private equity, long-term private equity. And some of those themes also flow into real assets and actually infrastructure and real estate. What we want to do is we want to bring all of private capital, our flagship infrastructure business and the long-term infrastructure business, and also our thematic real estate strategy. We want to really become global in all those three. And I would expect us to continue to do to buy teams or let's say smaller firms that fit into that strategy to become hopefully over time the global leader in what we call active ownership. Now I think we're top 5 or top 3 or something like that, and we're going to continue continue to grow and develop, but with that sharp eye on performance.
So you're not going to buy an insurance company to have your sort of like Berkshire Hathaway style float the way Apollo is doing.
And my prognosis there, that's at some point in time, that's going to be illegal to own your own customer. So I think that's not the future-proofed way to build your business, in my view.
Okay. Better get Apollo onto the next Newsmaker. Look, I just want to thank you, Christian. That was really good. You've been a really good sport. You've answered questions directly, and I think given us some really interesting insights. So thank you. Thank you to the audience for the good questions, and we'll leave it there. Thanks.
Thanks, Liam.